Hey, it's Soleil, and this is episode 417 of the Orange Pill Investor. I'm going to talk about updates on covered call ETFs and go over the overall covered call strategy. The volatility sellers get paid to wait, and the volatility buyers get paid to act. I think that was a critical lesson that I learned in November when I did not take nearly enough profits on my long call positions. But it also kind of reminds me that panic rolling is a recipe for disaster, especially with new covered call sellers. And so I'm really trying to understand what these guys are doing in these ETFs. Let me get rid of the chats. All right, so this was IMST last week on June 6th. And I went over this, and it looked like they were fully covered. Covered call strategies are a limited bullish strategy, and there's a little bit of controversy about whether these MSTY and other covered call products are suppressing strategies price, and they're just holding down the implied vol, all that good stuff. But I think it should be pointed out that these are actually bullish strategies. So this is not like naked selling. This is not like Chanos coming out and saying, I'm just going to take a naked short position, or I'm going to borrow shares, sell them, and then assume that I'm going to make a profit buying them back cheaper later. That's not really what this is. So every one of these funds wants the price to go up. Yeah. So all of these positions here in yellow, these are the synthetic long positions that they have put together. Oops. Yeah, where's my puts? Okay, yeah. Sorry. See these yellows and these yellows. The 365 puts get combined with the 365 calls. Both of those are actually bullish positions, because when you sell a put, you make money when the price goes up. When you buy a call, you make money when the price goes up. So the very base of all of these covered call ETFs is a bullish position. You have to, the retail folks have to own the shares, but in order to get around their little rules, they actually have to take these synthetic positions. So they're long the stock, is the point. And they are only short for like these very limited time frames. Next week, couple of weeks, maybe a month at most. And just, one of the little Excel functions that I used here is a VLOOKUP. Maybe I'll just cover that real quick. So if you use VLOOKUP, you can compare spreadsheet to spreadsheet. And so I'm going to look at the current dated tab, and I wanted to pull forward all of the positions that still exist on the other spreadsheet. So if I try to match up to A2, then I make the next column this range. That's what this table array is. And then 4 is which column that I selected do I want to bring forward. And so I chose the fourth column here so I could get the number of shares. And then in every case that I've ever done, range lookup is always false. And so this is identifying what positions were still existed on 6/6, but are no longer present. And common sense says that something that expires on 6/6 isn't going to be there today. So then the question is, if 276 shorts expired, what are they going to do? And the fresh spreadsheet that I downloaded today, which was reflecting the positions as of like last night, I'm assuming these aren't in real time. IMST did kind of surprise me a little bit. They kind of reverted back to what they said they were going to be doing, which was having a little bit more upside than other covered call ETFs. And I found that to be true. So it may just been this one little snapshot that I took, caught them in between their strategy, or maybe they're copying my homework or something. But now they have 1,693 synthetic longs, a little bit more. So they've added some positions, and I don't know if they have some inflows into the fund that allowed them to do this, or what, but they now have more long positions. And if I add up all of the short positions, that only adds up to, end this one. That only adds up to 1,311, which leaves 382 synthetic longs uncovered, which is pretty substantial. That's like 20%, over 20% of the portfolio. Yeah. But when I download the spreadsheet, I don't know how many intraday trades are included, excluded, or whatnot. So this is going to be interesting. And it's kind of a pain in the ass to have to go through and match these all up every single day. But maybe I'll just do that for a few days. I'm definitely not going to turn this into a long-term project because it is quite the pain in the ass. And then I ran the VLOOKUP again here from this spreadsheet, which will give me any positions that currently exist that did not exist last week. And that didn't return any NAs. If it can't find data, it'll return an NA like these guys. So as of today, every single position that is currently on was here last week, but the numbers have changed. So I've brought forward the contract volume. And some of these are actually, you know what, yeah. So some of these look kind of crazy though, because they had all right, so this is the 365 call for June 20th. That's this one. There was 1411. So why did it pull back negative 250? Okay, so did I do this wrong? Let's try this again. We can do this in real time anyway. All right, VLOOKUP. So I want to find security name on this other chart. Columns A, B, C, D. want to bring forth the share count and it's false. Okay, that's much better. I don't know what I bumfuggled before, but okay, so this is new. This wasn't here last week. So they have opened up a new 620 390 call. Not terrible, but it's 2 weeks to expiration. Actually, no, that's not true because this is now this isn't a covered call. This is a new synthetic long. Which makes sense because we have a higher synthetic long total than we did last week. That's 1,306. Wait, 1587 to 1693. Yeah, it's like 106 new positions. Yeah, which makes sense. Okay. So these are the new synthetic longs that they opened, and it doesn't look like they have covered them yet. And I don't know if that's intentional, if that they intend to leave it that way. But you can also see that the net assets is like 3 million higher or 7 million higher than last week. So I don't know if this is inflows or if this is capturing the premium that they have collected by maybe rolling some of these positions. But it looks like all of the covered calls were untouched. So the 613, 390s, and the 385s, none of those contract counts changed, which they shouldn't, right? If you're collecting theta, then you open the covered call position and then you just wait for the money to drain into your account and wait for this market value to decrease. And when there's not enough theta worth collecting, then you roll it. Or if you can roll it for a credit, to a better strike potentially. So I actually like IMST's positions better this week than I did last week. I wasn't a fan of the June 20th. Kind of figure like if you're going to be aggressive with the 405 strikes, you might as well just sell the weeklies and capture the most premium. But now those guys are the 410 and the 405. These are closer to being in the sweet spot this week. So I don't hate them. I don't hate these as much this week as I did last week. So it's fine. Just leave them there. Let the value crater. Looks like the most theta is in this bad boy right here. So this is basically an at the money covered call 1 week, in duration. Now they could have had this open for 2 weeks or 3 weeks, which I don't really like. But the fact that it's here and there's a ton of premium to collect, I like this one. If you're just going to be greedy and you're all about capturing premium and you're going to do a weekly, you might as well just blast away at it and do a strike or two over the share price. Now they could have placed this when we were at like 375, so there could have been a little bit more call away value in here. And the things that I'm thinking about here are the next covered call ETF that puts some of these metrics in place is really going to set themselves apart. So this is the Tasty Trade platform, and this column right here is net theta. This is something that you can quickly check to see, okay, I'm a covered call seller or I'm a cash secured put seller. Do I have net theta here? And it should should actually be positive. So I'm actually losing money every day on this. But there's no reason why these covered call ETFs on this page right here, other than instead of just listing their holdings, like why not have metrics like this so that the investor can look and see, here's the amount of theta that you're collecting, and then maybe have a column like, here's the theta that we're collecting per net liquid assets or something. And if one covered call ETF is collecting, 1/3% per net lick versus someone that's collecting 0.5% per day net lick, then maybe you choose one over the other. Another good metric I think that they could be adding would be a metric for total potential profit on a trade. So I think we're currently trading at like 380, 375, I don't know, somewhere in between there. And the call away value between the current price and this 410 covered call is the call away value. So that's potential profit. And then you could add that to the guaranteed profits that you're going to collect by collecting the premium on this. Add those two together, and that's your potential profit for that trade. Maybe a metric along those lines. I think that number might even be the most important when you're bullish, and especially for IMST. And MSTY I think they've shifted some of their focus to trying to capture some upside as well. That single metric, I think that's really the main thing. I'm sure they're looking at all kinds of TA and bullshit, but I haven't done a single shred of TA, and they were wiping the floor with me for a couple of months, but I'm now ahead of them by a not insignificant amount, and I haven't done any TA. I don't have a research team, and this really isn't. I don't think it's really that complicated. So if you're bullish, you want a balance between the current price, the share price, and the premium that you can collect. And adding up kind of like, I would call it like a potential return on capital metric, which would be, okay, I have to, let's say the price was $400 a share. I got to shell out 40 grand for the collateral. I can collect 1%, I can sell that for $400. Sell the covered call. So that's 1% guaranteed return on capital, plus the 2.5% call away value from 400 to 410 gives me a potential return on capital if the price goes above 410 of the 2.5% call away value plus the 1% premium that was collected. This actually looks like a 0.5% premium, but whatever. The point is still the same. I think if you're trying to capture the most upside, whichever ETF could, was selecting the strike that delivered the highest potential return on capital, which would be adding the percent potential returns on the call away value plus the premium. That should be like the KPI for a covered call ETF that's trying to capture upside. If their mandate is just to capture premium, then fuck it. Like, screw the upside, just sell at the money covered calls, just mechanically, indiscriminately, unapologetically, and blast the dividends back to the holders. Anyway, so I guess I like what IMST is doing as of today because it's at least in keeping with their stated goal of capturing some upside. Because if they have 1,693 synthetic longs, but only 1,311 shorts, that means that nearly 20% of their position is long. So are they anticipating that the share price will go up, or Um, are they just setting themselves up to add more covered calls? And then when I pull this spreadsheet tomorrow, it'll be back to even Stevens. I'm not really sure how they are populating these downloads. Like, if I pull this spreadsheet in 2 hours, will it look different? Or are they just updating these spreadsheets once a day after the close? Those are probably some questions I should figure out. But I don't hate any of their covered call positions today, kind of like I did last week. And they do have some net longs. So if they are trying to capture upside, then they're doing what they said that they would do. Let's check the chats real quick, and then I'm going to move over to MSTY. What's up, J Chief? Basically, it's all synthetic longs and 613, 385, 390s, 620, 405, 410s. Got it. Yep. Dude face, come the week before 620, we'll see some vol, is what this tells me. That would be nice. All right, so this is the one from today, but maybe I'll take a look at the one from yesterday just to set this up. So MSTY last week, I wasn't a fan, right? And another thing to note, so we argued about this a little bit last night about whether these covered call ETFs are fully invested. And as far as I can tell, they are, right? So I took the number of synthetic longs times basically the average price. At the time, it was about 380 times 100 because every contract is 100. And this came out to $64,334,000. And their net assets is 67 million. Anyway, so there's $3 million here of cash. And maybe they've got some inflows or whatever, and they'll deploy it. But the question was like, based on the rules, because they can't hold spot, are they only like investing like 25% assets under management? And no, they are fully invested. And the same should be true over here. Yeah. So I took the number of MSTY synthetic longs times the share price, 380 times 100, and that's like 4,663,170,000. And their assets under management is net assets is 4.7 billion. So they are fully invested. It's just to skirt like the IRS rules, the SEC rules, where they can't actually hold more than, I don't know, 25% of a single asset. They do these synthetic longs, and they literally just don't carry any shares whatsoever. And it's all guaranteed by these stupid ass treasury bills, which is probably the point of the law, just to force them to become holders of U.S. treasuries against their will. But I mean, it's returning more interest than cash, so I guess there's that. So yes, they're fully invested, right? All of their assets under management are being spent. It's not like It's not like it's a waste. Okay. So synthetic longs as of today. Well, this was it says as of today, but I can't imagine they had done anything intraday. So I'm assuming this was from last night, but it says today, so we'll call it update. We'll assume it's real time, even though I kind of doubt it. In this case, they've got a net long position of 1150 uncovered, so a little bit of upside there, but less than 10%. If IMST is to be believed, theirs was much more meaningful upside. And I hated a lot less of these positions as well, because last week I didn't like the 625s. And I ran my VLOOKUP again, and all of these positions are no longer, all of these NAs are no longer currently held, which makes sense again because all of the 6.6s had to expire. But I was glad to see that they closed these 625s. It's kind of like, why bother? Why go out 3-4 weeks and not even be like capturing upside? If I'm selling these a month out, I at least want to go to like the 425 strike or something. Like, if I'm gonna put myself on the hook for a month, I want to capture some upside. So I color coded these in red because I just wasn't real happy with these. So I was happy to see that they're gone. They covered them. Okay. The only new positions that I saw were these synthetics, I mean. So 9,000 new synthetic longs at 380. And actually, you know what? Yeah, these were covered calls, but they had some 405. Oh yeah, no, it was these guys. I want to call attention to these. So these synthetic longs are no longer here. So apparently they were long at the 420 strike. And clearly that hasn't worked out, right? We're still under 400. So they ended up closing out these 420 synthetic longs, and they must have rolled them down to these guys. They rolled their 420s down to 380, and they had to have paid for that, right? So that's not optimal. To a certain extent, these synthetics, I guess the strike prices kind of don't even matter, but I don't want to say it was a mistake, but it didn't work out, really. But again, yeah, I have no issue. I painted these all in green, so there's no reds here. So I'm also kind of not like big mad at any of MSTY's positions. They're all out to this Friday, and they're all, except for the 420, they're fairly aggressive. So I like that. They're capturing a bunch of premium here, basically just being premium whores, which I like. If they're trying to capture premium, then freaking capture premium. And the 420s was capturing a little bit more upside, but it's also the smallest position. There's only 2,000 contracts here. So I don't hate it. Every single one of these positions isn't necessarily one that I would do. I have done something like this in the past where if I want to sell 10 covered calls and I'm like, I don't know, anywhere between, should I sell the 385s or should I sell the 400s? All right, well, fuck it. I'll just sell two. I'll sell two of every strike between 385 and 400. So this is kind of like, I don't know if laddering is the right word for it, but kind of like a shotgun approach. Like, let's just capture every single amount of premium to call away value. But at the same time, that's kind of a little bit lazy. Because the calculation should be made, right? If the current share price is 385, well, there's no call away value here. So the only thing that you can capture is premium. And I'm totally fine with that if that's in your mandate. But then there's got to be some calculation here. The difference between 380 and 420 is $40 a share. That would be about 10% call away value. So there's a potential return of 10% here. Plus, what they only captured 262,000. So that's 130,000 on 1,000. So 130. Yeah, they probably only captured like a 0.5% premium here, but there's a ton of upside that they could potentially capture. And there's got to be a sweet spot in here, somewhere between at the money where there's no call away value and like, the 10 or like the 5 or 10 deltas where there's just no premium on a weekly. Well, there's probably some decent premium on a $10 or 10 delta weekly, but there's got to be some sweet spot. If you add up the potential percent return on capital for the call away value, add that to the premium that was collected, figure out the total potential return on capital, there's got to be a sweet spot. But if you're just getting a piece of all of them, then clearly you haven't done that work. You haven't done that calculation. And it's super easy to do, right? I mean, I'm sure they could automate it. I just kind of do it mentally when I'm choosing my strikes. So let's just say I was going to set up my positions right now. I own 100 shares. A real obvious example would be just doing it at the money, but let's actually make it somewhat meaningful. Should I sell the 395 or the 400? If all I cared about was premium, then I could just go here. But I mean, if all I cared about was premium, I could just sell the at the money strike and be done with it. So let's calculate the maximum potential return on capital. With the 395 strike, it's the distance from the current share price, which is 390 to 395. That's like what, 1 2/3% call away value, or maybe 1 1/4, plus the guaranteed $500, which is another 1 1/4. So your total potential return on capital would be 2.5% for this Friday. Going up to the 400 strike would be $10 of call away value. So instead of 1 1/4, it would be 2.5% potential return that may or may not happen if the price goes up to 400, plus like a little bit under 1% here. So in this scenario, if I'm bullish, I would choose the 400 strike. But at some point, the premium kind of becomes meaningless. And so the difference between, let's see, 390 and 410, there's $20 a share there, which is like 5% almost call away value in potential, but only less than 0.5% of premium here. So in that scenario, if you're super bullish, you could even justify the 410. But at some point when you get up here and it's like 10 cents, are you going to collect 10 cents on this? there's $60 of call away value here, which is 15%. 15% call away value. I guess if you're super bullish, you might as well. But at some point, like, why even bother risking having your shares called away at 450 for $10? This is like a tenth of a percent or something. Not even a tenth of a percent, maybe a quarter of a tenth of a percent premium here. So there's got to be some kind of balance. And it really shouldn't be that hard to figure out for an ETF with an actual like management team and research departments and shit like that. That 1% management fee should go for something. And just blasting away at every single strike between here and 10% call away value isn't really like it's not demonstrating confidence. It's just throwing shit at the wall and see what sticks, in my opinion. But at the same time, I don't hate any of these strikes, so that's why they're painted in green. I don't have any red this week, so I don't hate necessarily any of the positions. If we're bullish that the stock's going to go up, I also don't mind their philosophy of keeping some uncovered synthetics. So I guess I'll give a nominal low volume golf clap for both of the funds as of today. And hurry up and pump my bags, motherfuckers. All right, let's check the chats, and then I'll just do a quick account checks. Probably won't do any trading because, yeah, if we were up over 400 a share, I might be tempted to add a couple of covered calls and kind of lock in some profits there. But implied vol is still pathetically low. So I would really love nothing more than to add tons and tons of call buying. But I also took out 50 grand. I'm going to do some investing that I've never done before. I'm actually investing in Swan. So that will be a bias going forth that I will have to disclose every time I cover something. Like I was kind of annoyed with Strike because they, Jack Mallers is in bed with Tether, and I'm not really a Tether fan. And the other two Bitcoin only companies that I've heard good things about were River and Swan. And so I was like, all right, if I was going to switch my my Bitcoin buying platform over and I'm going to invest some money in Swan, I might as well use Swan. Unfortunately, Swan is still building out the rails for being able to like make Lightning purchases. Like if I want to buy a double smash burger from PubKey, if I'm in New York or something like that, I can do that currently on Strike, and you can do it on River. So I will be eagerly anticipating, Swan having that feature available. But like everybody's going to have Lightning at some point, so I'm not worried that they won't have it. I was just kind of excited that maybe I would be able to switch over to Swan and be able to. I mean, I've only bought 2 things with frickin' Bitcoin. Actually, is it just? Yeah, actually, I've only bought with Bitcoin at PubKey. So we took the trip to Steak and Shake in Vegas. I was so excited, and unfortunately, only the one that was out in town accepted Bitcoin, and I was not. I didn't really want to. I think that one was at fuck. What's the street that's kind of sus, a little different than the Strip. Fremont. I think there was a location in Fremont that accepted Bitcoin, and I was like, nah, I'm not going down there. Not for Steak and Shake, I mean. So that was a little bit disappointing. But I have received Bitcoin through Lightning People have given me lightning payments, split the bill at a restaurant or something like that. So the Lightning app is kind of a nice thing to have if you ever get the chance to buy something or have someone pay you with Lightning. It's kind of cool to do. All right, so I was getting excited because the price was getting like closer to 395. Did we touch 400? Must have got scared off from 400. No, not Tesla. Yeah, 395. If we crack 400, I'll be tempted to add maybe another couple of covered calls on or something. But in this low IV environment, I would really love nothing more than to stack a bunch more long calls. But as you can see, even in my current situation, I don't have positive theta in this account, which is kind of a no-no if I want to maintain my covered call seller's card, membership card. I would need to add probably a couple of like weeklies in here. And I know I said that I wasn't going to use margin, but I've got a couple of options. I can take like 30 grand off my HELOC plus another loan that I made, and I could deposit it into here and it's going to have no margin. Or I can just keep my my HELOC money available if I was to have some kind of crazy margin call, and then I could just move the money over. So I may have margin here until I can pay it down, which will mean, unfortunately, every time I take profits, I normally like to buy some shares, or actually maybe I'll sell some shares. 10 shares would be, I could sell those 22 shares. Yeah, these 22 shares isn't really not doing them any good because it's not an increment of 100, so I can't sell a covered call against it. And it's not really it's not really a high implied vol environment where I'm like, okay, I want to hold these shares. Or yeah, so maybe I'll cut down on this margin usage by selling 22 shares. It's not like really chipping away that much at the margin, but a little something. Make me feel a little bit better. J Chief, if I was doing poor man's covered calls, I'd be doing the same, only selling about 80% covered calls and staying net long. Yeah, I like that. MSTY is such a pain to sort through, in my opinion. IMST is much. Oh, yeah. To be fair, MSTY has $4 billion assets under management. IMST only has 40 million, something like that. So, big bank takes little bank. So, until further notice. What's up, Skeletor? Good morning to the G's in the trenches. Good morning to you back. So Steak and Shake caught in a LARP. Yeah, we love Bitcoin at one location. Yeah, exactly. This place looked like they had just recently opened. It was actually inside the fucking casino. Was that? Not the Rio. Aria, Rio? I don't know. It was inside of one of these hotel casinos that were off the strip, like pretty small, pretty small fry casino, and they they actually fucked up the order um, a couple of times. I think we saw someone else ordering, and they got their food, and they were kind of looking crazy at their food, and we had already like told them that our food was wrong. So like, yeah, they probably gave the other table our food, and they gave us their food, but the burger was good. Um, it was cooked fresh, and they cooked the fries in tallow, which was the other thing that I was excited about. The fries were delicious. They got the like little shoestring French fries. Um, did I get a triple? I don't know. I ended up with like a double or triple steak burger, and when they actually brought out the right food, it was actually pretty good. So um, I like that they're going to Bitcoin, even if they're kind of LARPing in the early stages. Um, but I also like what they're doing with the tallow and getting rid of the seed oils and whatnot. And I can't help but think those two things are related. Like Bitcoin is cleaning up the fiat financial system. Eventually, it will clean up the fiat food system and fiat research and fiat everything. I hope. I'm just really trying to live long enough to see what the world looks like under a Bitcoin standard. All right, so let's take a look at the ETFs real quick. So here's kind of the problem and why I probably didn't need to be afraid of the ETFs, because here's where the IMST paid out that whopping $7 dividend. Now, granted, that was for 2 months, so it was really not that juicy. But then the price just shits the bed, right? As soon as they pay out the dividend, they're not worth what they were worth before, because they just paid it out to the investors. So this is pretty normal. You should expect this every time the dividend's paid out. You should expect the price to crap the bed. But MSTY just paid us out, right? They pay us out over the weekend. Let's do his. Is it history? Let's go back 7 days. Yeah. Okay, so they paid me out the Misty dividend on June 6th. $7,297, and that was on about 100 grand worth. So yeah, 7%, I think, is what they said that they were going to pay out. And then I should have purchased. Is this my shares purchase? Received 354 shares long. Yeah, so the dividend. So I have signed up for the drip here. So they're automatically purchasing shares for me. Yeah, I think I had like 4,900 shares before. So I am giving these covered call ETFs the benefit of the doubt trading in this account, and allowing them to reinvest and kind of give them the best chance to outcompete me. But I'm not sure they're even making a profit at this point since January 23rd. If they are, they're up a very, very small amount. But to be fair, strategy itself is only up I don't know, 2% since January 23rd. 373 a share to 380. Yeah, so up $15 a share. Was that 3 or 4%? But in this type of environment, you would think that a covered call position would outperform because all of the premium should be profit. But the other weird thing is when investing in these covered call ETFs is their share price is whatever the buyers and sellers in the market think it should be. So they could deliver whatever dividends they want, and like MSTY could go up to $50 a share. IMST could go up to $100 a share, or they could just both go down to $10 a share and stay there. If investors don't want to buy it, like it doesn't have to correlate with strategy's price. It should be positively correlated if the world makes sense, but it's not like, let's look year to date. So yeah, look at that. So MSTY, like strategy's price is up 30% year to date. MSTY is down 20% year to date. Now, this is probably because of all of the dividends that they've paid out, but we're really going to need Bitcoin to rip and for the volatility to expand in order for these ETFs to really compete. So I don't know if that's a that's probably tough pill to swallow or bitter pill to swallow for the Misty Bros. But the dividends that they're starting to pay out because implied vol is lower now is not really making up for the variance of these two charts, plus the taxes. I guess if you hold, I don't know if yield max dividends are qualified dividends. I'm pretty sure like Strike and Strife are qualified dividends. I can't remember if you hold it for 90 or 180 days, something like that. If you hold the stock long enough, you get taxed at a more favorable rate. And I don't know if the dividends from these also qualify. I know the ones that are paid out as return of capital, I think aren't taxable. Not financial advice, not tax advice. But I think that's what I heard. That's the scuttlebutt, at least. IMST's price since it started. Up a little bit. There was definitely some excitement. They paid out their dividend and it's dropping, but that's kind of creeping back up again. So this would be nice. Maybe people aren't as disappointed in the dividend as I kind of thought they would be for paying out 10% for 2 months, because the price is creeping back up. So it doesn't seem like the investors are turned off yet. All right, let's blast through the rest of these accounts. Oh, you know what? I was going to make a deposit here. So Tesla's back up to 318. That's good news. So my put credit spreads were getting wrecked. I got the 29300s here, and we were trading below 300 down to 295 at one point. So there's hope for these put credit spreads yet. So that'll be nice. I'll probably continue to sell put credit spreads for as long as I don't know, if Tesla continues to double up, maybe by the rest of the year on Cybercab Hopium, unless the premiums dry up. At some point, if it doesn't make sense to hold the put credit spread, I just won't bother anymore. And I use the Kelly criterion formula based on the delta and the premium collected. to see if that makes sense. So here's the covered call challenge account. I've got 600 shares fully covered. This is not ready to roll yet. Maybe another week and a half. I'm like probably this should probably be a higher theta, but I am also bullish. And this is the advantage that I think as a retail trader I have over the covered calls because they're net long synthetic stocks, so they're net long shares. That's not leverage. The reason why the covered call ETFs were um, wiping the floor with me for the first several months is because all of these leveraged positions that I was holding all went to shit. But now, if the price is going up and I'm holding leverage, I think that gives me a little bit of an advantage. Now, granted, unfortunately, I had to peel off some of my leverage at kind of a low IV in order to get me to this 600 shares, which I'd been kind of like clawing and scraping to get to because it allows me to sell 6 covered calls instead of 5. And that's kind of huge. Like getting to that next whole number of 100 shares is a big deal. So I was willing to kind of take some leverage off the table to get there. But until we get the face melting rally that we're all hoping will happen sooner than later, every time I roll these out for a credit, I will be buying more long calls. That's the plan. That's my kind of well, there's 2 things that I think that I'm doing that should out trade the covered call ETFs. I think this is the proper way to trade upside and premium. It's 45 days to expiration at a reasonable, out of the money. So I think we were trading at like 375. So what is that? 10, 15, like 15% out of the money, 45 days out. Like somewhere in there is the sweet spot. It can be 35 days to expiration. It could be 52 days to expiration. It doesn't have to be exactly 45 because you can only get those on Tuesdays anyway. But if I wanted to just be super greedy, I would just sell these bad boys. Maybe 395. Like the tiniest bit of little 1 to 2% call-away value here. And just load up on the premiums. But I'm also kind of expecting some kind of gap up at some point. It took 6 or 7 months of chop from March to November. It's been 6 months from November, going on 7. And does it have to rally at the exact same rate? No. We might have to wait till December for the rally. Maybe Bitcoin shits the bed, or maybe we get qualified for S&P 500, but the committee tells strategy to fuck off. And, they just kick the can down the road and they don't let them in until December instead of September. There could be a whole bunch of things that would cause these Septembers and Decembers not to work out, right? So these are not necessarily locks. But it's also why I won't be holding these Septembers for more than another 11 days. And if they're still worth like $300 or whatever, I'll just sell the damn thing, break even, maybe lose a little bit of money. And then I'll just take that money and I'll roll it out to December and give myself a little bit more time to be right. But I don't really, if under 60 days is the sweet spot for selling, then I don't want no part of buying them. I know there's some super traders out there that can figure that shit out, momentum traders, whatever. But I'm not that guy, so I don't play in the sandbox that I'm not qualified to play in. If I ever learn that skill, then maybe I'll do a little bit more of it. Um, and every once in a while, I'll make a momentum bet play. And for example, 500 and whatever was all-time highs for strategy, right? And once we get there again, it will not only be a 52-week high, but it'll be an all-time high. Once we make $500 the floor, the support, now it's like price discovery. So at that point, I might be willing to take go long on something a week out and just, day trade it, try to scalp it, something along those lines. But it would be with a very, very, very small position. Number one, because it's degen shit. And number two, if I'm trying to learn a new skill, I'm not going to YOLO into it with tons of positions. All right, so nothing really to do there, but I do have some cash in the checking account that I need to move into that account, and I'll be able to take on some more positions. All right, the 5K account is holding strong. I've just got these. Okay, so GameStop had earnings. I guess this gapped down a little bit, so it looks like. So implied vol probably collapsed because of earnings. I think it was 50 yesterday, 40s or 50s. So IV's collapsed, which means that I should be able to buy this back cheaper, but the price also fell slightly. So let's just see if the premiums also collapsed. So if I wanted to sell a covered call at the money for this Friday, I could get 5% for half a week. It's pretty legit. So so even though implied vol has, we've had IV crush potentially, it really hasn't decreased the premiums that can be generated. So this doesn't bother me. If I get assigned the 100 shares of, where did I buy the 100 shares? Must have been in my, oh no, I did it in that account that I was just looking at, for God's sake. Didn't I? Yeah, because I got rid of the miners. So I might be running the wheel on GameStop is the short way of putting it. I will possibly get assigned 100 shares of GameStop. It's going to be cutting it close. If we stay 29.85, then this will just expire worthless, which will be fine. I'll just sell another put for next week. But it'll be fun to do instead of just running the miners all the time. And they did actually buy some Bitcoin, so they technically qualify. What's up, Dr. Tone? Let's see. What about buying long calls of MSTX? I don't really mess with any of the leveraged plays. I don't want to deal with the erosion that they have built in. And let's just say, so this is 2x leverage, right? If I want 100% exposure to strategy, just no leverage, I'll just buy shares, right? If I want 2x exposure, I can get this thing, right? Or I can just get the options. And let's do I'm going to go leaps. So theta's pretty small here. And 67 delta. Okay, so I'm just going to ballpark this. If I want 2x exposure to strategy, I can just go out, and if I get 2 of these contracts, that's going to give me the same exposure as 106 shares, but it's only going to cost me 16 grand instead of 38 grand, which is a little under 50%. So this isn't exactly like 2x leverage, but at least I don't have to pay the ETF a management fee. I don't have to deal with the erosion of these, that's more for like day trading. It's not really for people holding long term. And so I just don't like it. So really buying a call in MSTX, so now you're going to get leverage on top of leverage. If I wanted to do that, if I wanted like 4x leverage, then I can just I could probably go out here. Let's go to the like a 25 delta. Yeah. So what's 900 strikes? Yeah, perfect. So I could buy 4 of these, right? That's going to give me 100 delta for only 12 grand. That's a little bit more than um expensive than getting like full 4x exposure. But I would just create my own leverage. It's not like these ETFs have like special access. I mean, they get favorable like margin treatment potentially, or like I don't know. I think it's like capital swaps or something with the banks. They have to do all kinds of weird shit to dodge the SEC rules or whatever, or to fall in line with them. But the bottom line is there's some kind of combination of strike and expiration that would give me the 4x leverage that I want without having to own these leveraged ETFs that I just try to avoid like the plague. Unless I'm day trading. If you're a day trader and you want to jump in and out, maybe because they have to rebalance these things every single day. So I just don't like the idea of holding these leveraged plays, leveraged ETFs more than just very, very short periods of time. Let's see, since we are mostly all long strategy here, that could give us 4x returns. Let's see, I mean at the dips, then pull out within 1 to 2 months. Yeah, I would still just do the same thing here. Um, and you can still pull out of these things in 1 to 2 months. The way that Josh Mandel locked in his profits, I thought was pretty snazzy. Um, like if he had the 400 strikes, maybe he bought them at 50 and he wanted to lock in his 2x profits, but he didn't want to sell them early because if you hold these longs for at least a year, then you get taxed at long-term cap gains. So you can just come in here and sell the 410 or the 390. You're going to lock in your profits, but you don't have to close this position before they're eligible for long-term gains. So that's pretty cool. But for me, if this went in the money, I would probably just start using it like a poor man's covered call, and I would just start, I would just start selling covered calls against this. Like if we ended up at like 450 a share or something, this would probably have like it would end up being with like a 70 delta. I would totally sell covered calls against it. So either way makes sense, I think. You're absolutely welcome, Tone. My pleasure. All right, we're all caught up on the chats, and appreciate everybody tuning in. Be good, y'all.